is that over the last 180 days that we've filled 78% of our gap fills. Half gap fills have filled 92% of the time. This is one of the best days to anticipate a gap fill over the last 180 days. You can see that 74% have filled over the last 90 days. 89% of our half gap fills have filled over the last 90 days. That is time. In price, we are more than 30 points away from the previous day's 4 o'clock close. There's only a 35% probability of filling the gap in price. When we look at the ES and where we are in time and price here, there was a very similar type of situation to yesterday. We were in a pro gap up and go type situation. We were at these exact prices as well too. We ran right up to our previous trading hours highs that we were inside of yesterday. And we filled the half gap fill, bounced into a traditional short setup, and then filled the full gap fill, and then fell all the way back down to our previous lows. Here's what's interesting about our relationship with our leading indicators though. In US dollar terms, we're actually falling back into a full retracement long from lows. What does that mean for the indices? Well, there's a negative correlation right now with the broad markets, the major indices, and the dollar. You can see here deep negative correlations over the 30-day period, backed up by the smaller time frames. There are negative correlations for the currencies, backed up by the smaller time frames. There are even negative correlations for gold and silver. Inside of that negative correlation, if the dollar is collapsing back down into its support, what's going to happen to the indices? They're going to continue to be very buoyant. But there's also a trend break. And so there'd be nothing unusual about the dollar squeezing up into resistance. What would that do to the indices? It would create intraday weakness. So what we're paying attention to here is the dollar keep going straight down. If it does, the indices are going to have a hard time filling their gap. But a bounce into resistance would create the indices in an environment, at least in US dollar terms, it would create the indices or influence the indices to rolling over in the direction of a half gap fill. If we're thinking about bank, where we open up inside of this 50% short, do we open up inside of the top of the range? Yesterday's trading hours highs, it'll be interesting to see where we open up in relation to that previous high. Do we rally through it or sell off from it, creating a type of top of a range? And then in the VIX broke its extension, and we're very used to seeing this. Over the last 3 weeks, we've broken extensions, and then we've had new traditional short setups on the VIX that has led us into a continuation of these counter trend squeeze rallies that we have at the beginning of most of our weeks since February. That break of an extension also creates a potential squeeze into resistance. If we squeezed on the VIX up into resistance before we traded this support, what would happen to the indices? The indices would roll over in the direction of their half gap fill, potentially even their full gap fill. And then the question is do we defend that resistance? What would happen if we did squeeze up into the VIX's resistance level and the indices, say, fell into a half gap fill and the VIX defended a long from lows, or a short from highs? What would the long from lows look like on the indices? So over the last couple of weeks, we've had situations like this where we've squeezed from a counter trend. This stream continues at eMiniAddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.